Okay. So this is Pierre Lenders, and he is one of the trustees at the interdependence Treasury. He's been in the world of finance for quite a long time, more recently as an impact investor, generally in the world of sustainable finance. And he's going to be talking to us about a few different things today. So I'll hand over to Pierre. Thank you very much.
Thank you, Sam. Great to be here. All right, so I guess the topic that Sam asked me to cover is very much what kind of background will we deploy this interdependence bond. There will be a section at the end where I'll be trying to give some more numerical example and mathematical even formula to help people understand what this bond is actually built on. But before that, the purpose of the talk really is to try to bring a bit of my experience having navigated the world of finance, not just, to try to make a description of it as factual as possible, but more subjectively look at the contrast between how it's usually thought of or presented and what maybe you should keep in mind, especially in the context of a serious risk of civilizational collapse and the need to bring in some more tools to build resilience. And is the investment world prepared for any of what's coming? That's really the sort of question that I had on my mind when preparing for this talk. All right, so we'll start with just stating some obvious facts about wealth, how it's distributed, and who are the players in the field of finance and investment. Then I'll explain what are the inspirations that I got from various readings or talks or discussions, and I'll try to make a connection between what seems to emerge from talking to people who have given a lot of thoughts about environmental issues and what the concerns that have already been expressed within the investment community in the form of ESG investing or sustainable development goals, how much of all that thinking is actually coinciding with the reality and how harsh the reality is. And very much the take on that is that it's far behind. We did catch up. That's really a few $1 trillion questions. Then I'll also try to put investors more in the context of 2008 financial crisis, what this has brought, what it has changed eventually. To some extent, one could say investors have lost their mojo. There's a lot of reasons why it's tougher to be an investor since 2008 than it maybe was before. And I'll also look at the sort of help that investors get or don't really get from all their various stakeholders, including ESG crowd or governments. And then, as I said, I'll talk about interdependence bond, but no worry, that's going to be not so painful. Okay, ESG stands for, the E stands for environmental concern, S societal or society, and G governance. And it's very much a it emerged around 2004, 2005 as a set of tools that should be, or factors that should be considered when investing. And there's an institution which has become quite famous, which is the United Nations Principle for Responsible Investing, UNPRI, which has promoted the idea that it's important to integrate ESG concerns when you invest as an asset owner or as an asset manager, and that you should basically integrate those factors as if they were part of your normal due diligence when investing. And they've proposed investors of all kinds or service providers to adhere to a 6 bullet point charters that essentially say that they like the idea and they will do it, but they don't really formally oblige anyone to a specific path as to how to implement that. And there's quite a variety of ways to implement. And when you really do the work and make sure that you strategically invest, thinking about all the various elements that might affect the destiny of the company that you're considering for investing. And that would be very much, for instance, the way Generation, I don't know if you know about Generation, that's an asset manager led by David Blood, who's quite often mentioned as he has worked with Al Gore on setting a Generation, with this view that you shouldn't even have an ESG specialty when investing. You know, ESG should be part of the normal investing process, and you should really not consider that ESG goes against financial performance, that it would be a give up, that it would be a trade-off, that you would have to trade off between value and values. This is the sort of, very obvious statement that comes quite often, but it's probably the easiest way to remember it. I think Isabel already spoke a lot about ESG, so I will not continue defining it. But I will come back to a few examples where I think there are still some blind spots with ESG. Okay, so you know the rules. Ask questions. So let's the very plain facts, so that we have the figures in mind. Because sometimes when we look at the independence idea of building a set of assets to help local communities building food, producing clean food and energy. As I'll describe later, there is a mechanism by which we will all benefit from this venture growing, in size. We'll start with a few millions, tens of millions, hundreds of millions, billions. So it's interesting to just compare the sort of number we talk about with, the vast ocean of global wealth. And so sky is the limit, really. So the obvious first thing is that, it's quite impressive number. But there's a dark reality, which is that it's very unevenly split. Another thing which already you have to have in mind is that when you see this sort of concept that we are rich or we can measure our wealth, it's actually based on convention and trust. I mean, it's all based on the idea that we think the real estate in which we live or we own is worth that much because there's been prices or transaction. Same thing for contemporary art, etc. But in reality, and even money itself, is very much based on trust, as I'm sure you're familiar with. Now, another obvious thing is that wealth is very much correlated with GDP, and that's probably the main reason for our terrible addiction to GDP, because in everybody's mind, the more GDP we have, the richer we'll get. But as I said, it's very unevenly split. I think there's a statistic that probably everybody knows now, which is that just 8 people own as much as 50% of the population, which is quite crazy. Now, this wealth has been growing quite fast. I mean, that's kind of also a consequence of the 2008 crisis and the response to it, which has been, flooding the circuits of finance with cash and trying to force people into buying assets. And again, unfortunately, the way this distribution has happened has nothing to do with the famous concept of helicopter money, where Ben Bernanke was often mentioned as being thinking about distributing handout of £1,000 or $10,000 dollars to every American, but it very much went to making the rich richer. And that has happened through various asset classes, and we'll talk a little bit about asset classes. So here it's just a split between equities, private equities, government, and just deposits. And it's a study that McKinsey did prior to the crisis, where they had figured that or forecast around 200 trillion worth of securities, and by 2010, and we are well Now, what happens in these markets is very much a result of comparing what is available in every sort of securities, equities, bonds, and then, of course, you have to drill down what kind of bonds and what kind of equities by region, by sector, etc., and what investors consider they should have in their portfolio. And obviously, it's never exactly in coincidence. Investors change their mind about what they think they should own, and that obviously drives prices up and down. So here, as an example, I found the way Norwegian sovereign fund considers that they should be investing, and you see that 2/3 of their portfolio they think should be made of equities because they have a long-term perspective horizon. For instance, they don't want to take too much inflation risk by owning bonds, I suppose, or things like that, and they need. All right. So you take a company that has a certain size and standing and needs funding. They have different ways of obtaining funding. It's typically debt or equity that they will think of, and then you have all kind of intermediate or alternative ways of funding, but that's much smaller. So equity would be a security issued by this company, whereby the owner of the security would be given an access to the bottom line or share of the bottom line in the form of dividends every year, and they would be served. They would be the last served. So the company generates revenues, all costs being paid, all interest being paid to bondholders, which is another form of security, and all tax being paid. Then what you're left with is the distributable profit, which comes in form of dividend, and that's equity. And bond would be higher in terms of seniority, access to the cash flow produced by this company, and would typically be a security where you have a fixed coupon and a fixed maturity, and at maturity, as an investor, you get reimbursed the full capital that you put initially. Right, so this example shows you that Norwegian wants much more equity in proportion in their portfolio than they are. If you look at the global market, equities represent about 40% of the available securities. But obviously you have other types of investors who prefer bonds to equities. So they all, at the end find the right level of prices, which allows everything being in balance. But as I said, this balance constantly shifts. This is a little bit the easy approach to markets, where you bring in the concept of efficient markets. Efficient market is essentially a market where every security is at a price that incorporates all the available information. And what happens when a new information comes up, for instance, you have a report saying that inflation is on the rise in the UK, then investors realize that maybe if they own bonds with fixed coupon, they might suffer from high inflation, and they will prefer not to have as many bonds as they used to have, so they will want to sell them. Likewise, in the equity world, if someone realizes that there are more and more vegans around, they will like the concept of buying companies that produce meat substitute more than they used to, and then they will start buying them, but maybe there are not so many around, so the prices of those securities will go up. I mean, that's a very basic level one way of describing what happens in market, and that's very much also what most people in the academic world used to use as a framework until we got more behaviorists joining the party in terms of explaining markets. And I'll talk a little bit about that. So as I say, also central banks play a role in driving markets. The usual way has always been for central banks, I mean, I'm taking the Fed, and most central banks have now adopted a very similar approach to markets, has been through short-term rates. With short-term rates, to make money more or less expensive to debtors. So, the higher the rates, the less you will feel animal spirits to borrow a lot of money and invest in new projects. The lower the rates, on the contrary, the less you'll be inclined to keep your money in cash, and the more you'll be inclined to try and venture into higher yielding securities corresponding to eventually risky projects. And this chart shows here exactly what happened on that front in 2008 when everybody got so scared, everybody who had investment got so scared after the market performed so badly that they wanted to stay in cash. They had no clue what was going to happen, and they preferred to miss the opportunity of a rebound, but to at least not lose more of their capital. So central banks embarked on this policy to push rates, nominal rates, so low that real yields, real rates, which is what we have when you subtract inflation, became negative. So essentially, you knew you would lose money by not investing. In fact, if you even look at securities issued by the German government, when you bought German bonds at 100, you knew for sure they would be worth less. You would have negative rates on those securities when you would get your money back. But it was the price in the market because people were so scared that was their preference at the time. Well, as you know, equity markets have soared since 2008 as very much a response to this policy of central bank to push rates lower. But not only that, also central banks intervened very massively in a way which was very unconventional by quantitative easing. Quantitative easing meaning they grew their balance sheets quite dramatically, buying all sorts of securities that without them intervening would have probably defaulted. They almost bought the entire banking system, in some places where banks had extended themselves far too much into the real estate market, for instance, which is a way to comfort the argument that was made before that when you say wealth is at 300 trillion, you really don't know if that's where you could liquidate it if you wanted. It's all based on trust. Now, if we turn to who are the other players, and it's going to be important, when we go and talk to potential partners on the field to build this interdependence network. Of course, the first one that comes to mind, retail. Typically, they are very much home-based. They like to invest in things they think they know because it's in their country or it's named they're familiar with. They buy the products. In terms of being savvy investors, generally speaking, they're not. I'm sure you're familiar with the little footnote. Past performance are not indicative of future performance, and there's a reason why it's there because our reptilian brains really doesn't function this way. That's the only clue we take from anything. It's the past, and what has worked should continue to work. And in fact, most you go to a retail bank branch, and that's the pitch you will have from the bank. Oh, you should look at this. Look, it worked very well, which is of course totally silly, but that's how products being sold. Now within asset managers, and I'll show the numbers. How much they represent, how much they manage. It's quite different in the sense that they're supposed to be professional, so they can't really justify the fees that they will collect unless they deploy investment processes that are well thought of. There's a lot of marketing going on there, but because if you really think of it, having a very structured investment process maybe deprives you from the agility that is required to change your mind when it's appropriate. They also, obviously, most of them are specialists, so they specialize in equity, or even more, they specialize in UK equity, or even more, they will specialize in UK consumer equities, because the deeper you drill, the more likely you are to get in touch with these critical information piece, which will help you better understand the outlook and position your books accordingly. Another point to be making again on this category of investors is that what we really care about is getting as much assets under management as possible. They really need more assets because that's how they get paid. They get paid commission, which is a percentage of how much they manage. Then you have the asset owners. The asset owners would be your pension funds, insurance companies, etc. They tend not to manage directly themselves. They tend to go through asset managers. So when we look at the total assets, the management figures, you have to think of a lot of double counting there. There's typically a pension fund who manages 40 billion. Well, they will allocate almost all of that to asset managers, and you see the numbers popping up twice. Problem with them, they are typically in the grip of large consulting firms who have deployed frameworks for investing which make them quite slow and bureaucratic. They are typically long-term investors who are not in a hurry at all, and they miss a lot of potentially market opportunities. They don't really care. The people themselves in pension funds are not the best paid people on the planet, or at least in planet finance, compared to investment bankers or to successful asset managers. So they really don't care much about trying to get performance. They try not to be blamed for having made stupid decisions, so it's much better to have consultants around. The one population which is quite interesting, maybe for us as well at interDependence, is the family of much more agile players, family offices, among which we find the Melinda and Bill Gates Foundation or the Soros Foundation, so they tend to be very much self-driven. They don't need to report. They don't report to anyone. They follow their own fantasy eventually. And quite a number of them are, becoming quite aware of what's happening. So there is a potential opening there. Now, just some figures so that you have, an idea of the size. We are not at 300 trillion because this doesn't incorporate, contemporary art or real estate or things of the like. So it's only, we're talking about securities here. And you see the vast, the big numbers for asset managers, about half of that 170 trillion pie. And you see the ones that are quite interesting, I just mentioned, the outsourced CIOs, family offices, endowment foundations, are just a very small fraction. But it's a small fraction of a huge number, 3%. CIO is Chief Investment Officer. It's, you can think of it as a family who has been quite successful at setting a corporate in the industrial world, has accumulated wealth. They don't really want to go to UBS Wealth Management with that money. They think they have enough to set up their own investment arm, but they don't feel they necessarily have the skill set to do so, so they hire an investment officer from an investment office who typically would act on their behalf, not just for them, but maybe for other families as well. I don't know if that's been clear enough. All right, so, but as I said, the game in town is to get bigger. You have that constantly in the industry and everywhere. It goes very much against our own idea that local and small is beautiful. So we need to be aware of that. The argument behind here is one that says, the bigger I get, the more money I manage for you, the best access, the better the access to information. And what will give me an edge and will allow me bringing you performance which will be above my peers is that I will have better information. So give me your asset and I'll give you more assets and I'll perform better. That's the marketing pitch. And it works. I mean, if you look at the top ranking asset managers in terms of size, you have quite impressive number, and the growth has been unabated for the biggest ones. So BlackRock is now, the first one mentioned here, is at around 8 trillion. All right, now let me make a little survey here. Well, I think you know my answer already, but anyway, I'll ask the question. So, investors are very rational people. They want to make money out of understanding, what's happening in the world. They've seen the Tesla story, so they know that if you invest in the right technology, you can make a lot of money. So my question to you would be: do you think that maybe it's taking a little bit longer than one could hope, but ultimately, investments will go where they need to go from this investment world? Or do you think that no, they won't be up to the job? So who's in favor of A? Who's in favor of B? Okay. So you're massively with me, and that means there is some irrationality actually below the surface, and I guess that's the next section, trying to uncover some of the cognitive biases or darker reasons, really, why you have to be quite aware it's possible it's not going to come smoothly. So, just a few words about my background. So, I've been around markets, as Sam said, but in various functions. I've been dealing myself directly with investing or trading, market making. I've looked at risk technology quite a lot. Hedge fund selection. I've been in the hedge fund world also many years. I've set up shop to advise asset owners in how to pick managers on the basis of reliable evidence that those managers were doing efficient incorporation of ESG factors in their investment process. And more recently, I got interested in more private, illiquid securities as an impact investor. Impact investing, if you're not familiar, is a denomination for an approach where you seek not just to get financial result, but also very concrete result in terms of number of people that get access to food or shelter or education, or amount of CO2 emission that you avoid, or number of liters of water that you avoid wasting, etc. Source of inspiration, some of them I really recommend if you haven't read them yet. Harari, which helps remembering where we stand as a species on this planet for as long as we've been around, and that highlights how short the last 12,000 years are in terms of our existence as a species. So we shouldn't take for granted what we've experienced in the last 1,000 years should necessarily define us. Also, various neuroscientists or people who've looked at behaviors in Kahneman, Ariely, Gilbert, Schwartz, etc. You can't understand this world without, obviously understanding what's happening with artificial intelligence and automation. Martin Ford has written a good book about that. A guy who spoke quite well about agriculture is Richard Manning. In terms of understanding market dynamics, Boom and Bust, George Soros has written great books. Niall Ferguson, The Asset of Money, also something that is quite inspiring. I think Einstein, just to mention, you know what the five biggest truths are, right? The first one is Moses, all is low. The second one is Jesus, all is love. Then you have Freud, all is sex. I think I forget the fourth one, but Einstein comes and all is relative. So. Ernst Zucker wrote incredible books about trees. He will teach you that trees create fresh new water molecules, which very few scientists and even less people know. Quite impressive. The Bourguignons were incredibly early in figuring out that what we do with intensive agriculture is actually absolutely devastating to our most important capital, which is topsoil, because they realize that it's all a life of bacteria that's underground, which helps us getting food and nutrients. Then Pablo Servigne is French. I'm not sure you would find English translation, but he's talked a lot about effondrement or collapse and how to adapt to collapse risk. All right. My core beliefs, and that will probably explain the take I have on a number of the behaviors that I witness in the investment world. First is really that you should always remember that it's all narratives. That's one of the things that, of course, Harari mentioned in his book. But also that narratives are built by the elite. And we all live in a lot of narratives which we believe probably come from the holy books or from some truths that everybody shares without realizing how much those narratives actually serve a purpose. And a purpose that comes from the top. The second belief, which I've developed, which again you might very well disagree with, but is that there's a very important shift that's happening just now because of a very strange coincidence. Two things are happening right now, which I'm not sure why necessarily should have happened together, but they do happen together. And that is probably creating a situation which is totally unheard of over the last 12,000 years. And then the last one is, I don't know if you've heard about the Fermi paradox. It's very strange. We try to listen to outer space and to detect electromagnetic signals that would be structured and would signal life somewhere, and we don't. And maybe an explanation is that, unfortunately, life is built in a way where you get clever much before you get wise enough to avoid extinction.
You gain the ability to destroy yourself
exactly.
much sooner than you do to understand that power.
Exactly. So what is the coincidence I was talking about? Well, it's simply that you have, at the same time, a realization that the planet has finite resources, that there are limits to how much you can continue to bet on this unabated growth chart. I mean, at some point you can't keep growing. And at the same time, you have automation and robots, which for the people at the top totally changes how they should envisage building a future for their kids or for themselves, because they no longer need people. If you think of it, rich people in a pyramidal system always needed more people because you needed more farmers first, you need more soldiers because you needed to protect your harvests, or you needed to try to steal your neighbor's harvests, and then you need, administration, and you need a court, etc. And even when you get to closer to us in time, you need more workers, you need more consumers, all that because your companies will then get fatter bottom line and you'll get richer and you'll enjoy more. But that's a very interesting question for economists. I've seen very few economists even venturing in figuring out whether there wouldn't be a proper way for rich people to feel even richer with less consumer. Well, in fact, you already see that luxury brands, for instance, have outperformed massively mass market, sort of brands. So that's already telling you something there. So that is something where obviously you don't hear much of that being talked about in the investment world. The investment world continues to be very much focused towards the old regime, the old way companies should get more revenues and pay more dividends just by benefiting from growth.
Just to go back to the last point, where you say robots and footprint concerns, you mean our impact?
Yes.
About our impact.
Yeah. I mean, it's a bit brutal. I'm going to say it very brutally, but I'm afraid for the people at the top, not only most people have become irrelevant to them, but they are dirty.
Yeah. All these people burning coal and kerosene.
Exactly, and they prefer to imagine themselves, maybe in fact in a few hundred years, when those who will be there will be like us or slightly transformed or very transformed, they will look back at 2019, and they will say, oh my God, poor guys at the time. Remember, apparently there were more than 7 billion, and elephants were dying, and they wouldn't breathe good air. That was terrible. It's a bit the way we talk about the 13th century plagues. Terrible time.
Longer than 100 years ago.
I'm sorry?
Longer than 100 years ago. It was covered of smoke.
Yeah, absolutely.
And things was very, very good.
Yeah, so now you have areas where things have gotten better, but if you look at what you have in your plate, for instance, things are much, much worse. So, and you do see signs of, less fertility rate, low fertility rate, just physiological. So maybe some responses that nature has already engineered to help us get into that path sooner than we might have anticipated. Okay, so this is really the reason for my base case scenario, which apparently I will not necessarily be the only one to put as base case scenario, but it's really not what the investment world considers the base case scenario, or at least certainly not in the public discussions. Privately, I'm sure many people start realizing that, especially those that have been in the ESG crowd quite early and have been quite discouraged at the pace at which the obvious things to do are not being done, come to this view. Which is that we will act too late, and so there will be major disruptions. And yeah, we see signs of that, and I'm mentioning, the weakening of democratic life, corruption of science. I mean, governments no longer really providing for independent checks on food safety, for instance, is a perfect example. The European Food Safety Agency is just a disaster. You see fake news and migrations being very much driven by what's going on there. Also, the education system, which is falling apart. And the education system is very much a reflection of how much people want to invest in the future. And if you don't care anymore about education for the masses, it's a very clear signal. The dark reality, because you could say that's because people haven't realized, but there was a pretty good article in The Guardian which was talking about a discussion that had taken place where very rich people had organized a seminar where they invited specialists in, futurists, or I'm not so sure exactly how they would describe themselves. And this futurist guy in this article explains he was quite shocked at some of the questions that were asked, which were, not general philosophical questions, but very practical questions, such as, okay, so when we go into this world where we need, people to protect us and to protect our houses or bodies, etc., against certain violence that will come. In which currency should we think of paying them? Because currency will have collapsed. So, so I'm not saying they're all in that camp yet, but you have to realize that because of the inequality of wealth distribution, it's not so much the fact that people haven't really realized how bad things are, but more that they realize that they think that the best strategy for them is to do nothing about that and just prepare and buy maybe a piece of land in New Zealand or. Yeah, and then, of course, you could wonder if that's so rational, if they really can think that this is the best possible life they could dream of. Yeah, I think you could imagine that being just a few million people and having solved the issue of environment just by slashing down the footprint caused by quantity and replacing quantity based objectives with quality-based objective, is actually quite a noble thing to do. I mean, philosophically, when say saving mankind, you don't say the same thing as saving people. It's really not the same concept. More reasons why, not just because of that game theory aspect or preference from the richest, but also coming from everybody else, we might very much stay in that scenario. Is first, narratives. I mean, we still very much ourselves, all of us, I'm afraid, in this narrative that there is a link between consumption and happiness. So we're trapped in that. There was an interesting book. I don't know if it's certainly going to be translated soon by Sebastian Boller about our striatum, this piece in our brain which controls the dopamine circuit, and which evolution has placed there, and we are very successful as a species because this has worked beautifully for us. So this striatum is pushing us constantly, or pushing our neocortex, what we think makes us very rational and intelligent people, to essentially concentrate on one objective, which is immediately, right now, get as much power, food, sex, and information as possible, and get all that in the cheapest possible way. And it takes a lot of meditation or education, to patience, to be able to mobilize a neocortex into longer-term objectives. And people in the financial world, they're not different, obviously, from us. So the obsession with short-term gains is there. Another thing is very difficult to anticipate the future when it's not going in straight line. We tend to always look at, what happens, what is now and what was in 10 years ago, and then we think, 10 years from now it's going to be just straight line. I mean, that's also a cognitive bias that evolution has given us, to be a good ape in the trees, and it's been very helpful, but not so much in anticipating the impact of the environmental disaster, which, as you know, work very much in self-reinforcing ways and accelerating manner. And the endowment effect, we really think what we have, if we have it, is worth more than if we didn't have it. There's a famous example of a guy who owns a wine, cellar, and has not insured it, and has insured it, and there's an incident and it disappears, and then the insurance is ready to pay the exact price for it, and no, it doesn't need it, it doesn't want it anymore. It's not there anymore. He has a better way of using the money now. All right, and the last thing I would say is this very deeply entrenched belief in bigger is better, and to a large degree, and even for us in interdependence, of course, we will be looking for economies of scale. I mean, we can't survive if we don't manage to get economies of scale in things we're doing. But it has turned too much into an obsession, which has also given probably some players far too much power, because it has turned into essentially, for instance, giving oil companies, who were the ones who managed, to get scale in the previous era, far too much power in dictating how things should be run today. I don't know if you heard about Paul Schifulka, but he's tried to lay out how typically people go about realizing that what's happening will have an impact, and how should they react to that. So he's written a very short document, Climbing the Ladder of Awareness, which I think is an interesting guide as well. 90% of people are still at stage 1, which is deep, dead asleep. But I'd also techno-positivism. You don't really need to worry too much, because the system functions, it has always functioned, and therefore it will still function. The famous interpolation, a straight line interpolation. That's what you hear also a lot about automation. Well, there's been already shift in the past where new technology have emerged and people were scared about jobs. being lost, but in fact we created so many more opportunities in new sort of activities. So the same will happen now with robots. It will be fantastic. It will be everybody will have a much more interesting job. Then when you really think a bit hard and do more research, you get concerned and you get to the second stage. You're aware that there's a fundamental problem, but quite often then you find one and you think you can solve it all. You can solve it all by saying everybody should be vegan and that solves it, or we should just go for photovoltaic solar rooftop and that will solve it. Until you realize, no, well, there are actually many problems and they are interconnected. And I think you had Eckhart Tolle in your recommended reading list, and indeed I think that's probably the sort of readings that you need when you get to the fifth stage, where you might just get very depressed, or you read those sorts of book and go for inner path, or you take the outer path. And I think interdependence very much is in this in this category of reactions that one should have when considering how bad things are. But all this is not completely news in what I'm saying about irrationality of people in the investment world. Keynes made quite a number of suggestions that it's always been the case. I'm sure you heard about, I'm just going to read this one here. That was after the 1930 crisis. A sound banker, alas, is not one who foresees danger and avoids it, but one who, when he is ruined in a conventional and orthodox way, along with his fellows, so that no one can really blame him. And I think you were mentioning game theory for the top of the pyramid, but also that is very much game theory at play here in the investment world, which is even those who realize that there are huge problems and issues coming, it's far more important not to be blamed for maybe being a little bit too much ahead of the curve.
Do you think that's the bias that we overvalue what we already have?
Yeah, you could see it this way. I mean, I think it's career management, mostly. I think when you look at what has happened, and I'll come back to that later when discussing the impact of 2008 and the zero-rate environment. But previously you were in a world where it was valued that you would take aggressive position in terms of making bets on what the future would look like. So if you think things are going to go in this or that direction, you shift your investments and you hope you'll be rewarded for having been ahead of the curve. But nowadays, the smallest mistake is immediately sanctioned because all these institutions, they see their revenues going down. I mean, they might increase assets and compensate for the obligation to reduce fees, but it's very important for them to always find people they can fire so that they get their costs down. So if you make the slightest mistake, you're immediately out. So I think it's more career management. I'm not going to go through all of them. Maybe if one of them interests you, but I've tried to list a number of the fallacies or at least, minimum very slippery concepts, contrasting with, what I was describing first as being the standard way to describe finance and efficient market, etc. Sorry, you had a question? No.
I pass.
Okay. So the first one is, often hear about, economics as a science. To me, it's really not a science. It's really just a bunch of narratives, quite often politically intended narratives. But economists love to get Nobel Prizes based on, what they would consider are complex enough equations. I mean, when you compare it to the sort of equation you get in physics, it makes you laugh, but that's often how it's presented. But it's important because it gives authority. The second fallacy is, I think people are quite oblivious of the fact that economics, finance, is is based on it's based on accounting. It's based on realities which are pretty much universally the same across the planet. When in fact there are quite obvious cultural biases. I mean, if you take the example of the Japanese lost decades, I should put an S at the end of decades now because it continues. I think you can trace it back to the disconnect between the culture in Japan, the face-saving culture. You don't default. I mean, you have to keep going. You can't accept that something has failed. With GAAP accounting, I mean, in the U.S. and they brought in the U.S. way of managing companies, or at least reporting on company management, and this has gotten them to that point where they prefer to extend the maturity of the debt that they had on their books. All their balance sheets were absolutely failed, but instead of saying that they were bankrupt, they said, well, instead of giving back the money on the debt in 3 years as we had planned, well, we'll give it in 10 years or in 30 years. So face saving, no default at all, but as a result, obviously, lost decades. A big question about 2008 central bank interventions. We all say, "Oh, great! Government stepped in, central bank stepped in, we saved the world from crash." That's commonly admitted fact. You can actually question it. Maybe we'd live in a better world if we had let things gone their course much deeper. There would have been more disruption, but maybe something healthier, safer, smarter would have emerged from a low bottom. Markets efficiency, obviously that's very much disputed now. How much does the price of security reflect the prevailing information, or how much is it just a function of the craziness, irrationality, herd behavior of people who, for instance, you're a fund manager, your peers have all piled into this company that no one really likes, but hey, if you don't have it in your book, you're going to underperform, so you'll be fired. So you buy it as well, and so the price keeps going up, and certainly does not reflect any fundamental reality. Which obviously ties into the next one, because you think that just thinking correctly about values and fundamental realities will make you richer. Actually, it's much more of a game of mirrors. It's not so much understanding what is at stake as understanding what other people think about what is at stake, or about understanding what other people think about what other people think about what's at stake, and etc. So, which brings to the next one, which is, are trading and investing so different? Because you often hear that trading is kind of short-term, bad, not helpful, but investing is noble, because you build the future. But again, in reality, it's the same sort of incentives that people who are in charge of investing are submitted to, and have career management, considerations that get into the line. So yeah, maybe the time horizon is different, and as I mentioned, if you talk about foundation, endowment, pension funds, or even high net worth individual, you can have some hope that for them investing is a long-term game where they would consider long-term factors. But those are probably the only ones, and they represent a very small fraction of the entire crowd. Do prices inform on value? That's another one where people don't really understand the difference between marginal and average. The price is only where the last transaction happened, and it's not at all necessarily a reflection of where the entire stock or inventory of a given security should be valued at. But that's the only thing we have, so most of the time we think that that's good enough. What is the cost of money? You hear people saying, but it will cost us that much to invest in the transition. We need to spend, trillions, and we spend billions. Well, up until we were in the gold standard, you could say there was a real cost to putting money on the table. Because you basically have to dig the ground. You have to find some more of that gold, which, as you know, is created only in supernova explosion, I think, and because you need very specific temperature and pressure conditions for gold atoms to be created. So it's fine. It's like Bitcoin. There's only a small number of them, and therefore there is a cost of putting money on the table. Today, it's basically just a keystroke on a computer. You can create 1 trillion if you want. Just central bank do that every morning. So, what is the cost of money? Is I'm not sure well understood. To me, it would be essentially looking at scenario analysis. You have to try to figure out what the world would look like if you do spend the money this way versus what it would look like if you don't. And that's a complicated and very qualitative exercise, but that's the only way. I mean, if you spend 100 billion in accelerating transition, clearly you will, create lots of positives, which might not be there if you just, try to kick the can down the road and continue to finance zombie institution or the oil industry, etc. So to me, that's how you should appreciate what the cost of money is, but that's not often the way people look at it. I think 80% of people consider themselves smarter than the average, which obviously is sort of impossible. There's an underlying also assumption in the investment world, which is that everybody can and should beat the market, which clearly is impossible. And the last one is somehow different, but it has lots of also intricacies. There's a lot of intricacies between this question of labor and job market with finance, because the mainstream thinking obviously is that everybody should have a job. We start talking more and more about universal revenue. I mean, I don't know, I'm not sure how it's called in English. Universal income, basic income. And I think that's probably one thing that will have to emerge as a result of automation. And it will also have serious implications as to a lot of the way economists and people in the investment world think about the next phase. Are there any question now?
I'll just have a reflection that there's an ethical issue here, because if you invest in automation and you let lots of people out of work, then the automation will let you be richer because you have to pay less and you still producing. Your chain of production is going to be absorbed by people, because people buy products. So there's an imbalance. You're putting people out of work, but you're still expecting them to buy your products. So at some stage, someone should say, okay, you should pay a large fee because you're making money out of nothing.
Yeah. And there's
others.
There is a concept like tax on financial transaction, or taxing jet fuel for planes, etc. But there's a third one which is coming, which is still quite a minority, but taxing robots and distributing the proceeds of those taxes to people. But this is where really the main question is: can
robots or the work produced or the benefit produced by using robots? Because you can tax one robot, but if this robot works as 20 person.
Well, you tax the robot and you give this money to the people who otherwise would have been employed, so that they can consume the products produced by the robot.
But now it's a dog biting its own tail. So if that
it is
in place, what's the point to buy the robot in the first place?
Well, to maybe save the pain of working. And that's where I think there needs to be a transition from where we are now, which is a human being can only get a satisfactory life if if it has a job, if it has if it expresses itself in a job, to having a purpose or having activity. Activity doesn't need to be a job. But it also ties back to the question of how the top of the pyramid envisage how to be rich in the future. Will being rich in the future necessarily be owning companies that has millions of consumers, or will it be being the one who owns Himalaya?
What are your personal views on the universal income? I know that everyone has a discussion now in many Western countries, like the United States, really kind of advocating for it.
Yes, yes. Yeah. Well, I think it's a necessity. I think it will happen. Mainly for the reason that it will be one of the ways to avoid violence to creep up. Because for the moment, the only strategy people have when they realize that most likely their future or the future of their kids is compromised because of the loss of jobs, etc., and the economy, is to go for extreme right wings, sort of theories, closing the borders, and trying to go back to the world as it was, 20, 40 years ago, which this is fantasy. This will not happen. So essentially, people today are confronted with a tail risk, an extreme risk of potentially not having a roof, not having food. So the need for basic income is there, and will be a response that politicians, I think, will implement rather quickly. Yeah, I think it should. Yes.
But I think I hope we learned a massive lesson from what happened in the United States in the last crisis, where thousands of families were up on the street. And the bank system was forced to sell houses for $1 because they found itself with this huge amount of numbers of houses which after months and no maintenance were decaying.
Yes.
So it was no, if you look in that direction, what happened was totally foolish, not constructive. And at the same time, sometimes there was just few individuals buying streets for $1,500, contacting back the original owners and give you $200 to go to your house. So in the face of the bank threw them in the street because the $30,000 were missing from their account, and then the same guys then buy back this house for $300. So this scenario, it was crazy. I was there at the time.
But I take Warren Buffett as an example because he's often mentioned as someone so smart, etc. But it's a good example of how this system works and helps people who don't have the tail risk or can take risks, get much richer, and volatility. And when things move violently up and down, that is like shaking the trees. And it's only those who already have a lot of wealth who can jump on opportunities. So Warren Buffett, for instance, in 2008, what was the situation? Well, he was a lot of the firms he managed would have been bankrupt if things had gone further down because he had been selling lots of puts, which is optional. I'm not getting into details, but so what did he do at that moment? If things were to continue to go down, he's got those limited liabilities vehicles that would have gone to zero. He's got lots of wealth still somewhere else, but this thing would have gone to zero. Whether things go down 10% more or 30% more, it doesn't matter. This is, it's down to zero. What does he do? He buys a lot. He borrows more money, and he massively buys the market. We are 2008, prices have collapsed. Because if things go worse, it makes no difference. Right? Has nothing to lose. Nothing to lose. But if things go back up, he'll be twice as rich than if he doesn't buy. And he's considered a genius. But there's nothing genius about it.
The question from someone online, are there any examples of people in the 1% who have radically changed their investment behavior without causing panic?
I think they do it maybe in a way that you wouldn't know. But well, in the 1%, I would mention Soros. This is an interesting one because up until a few years ago, he had been in the traditional way of running his hedge fund in the most aggressive capitalist way. I mean, whatever works to make money, and then he would take all the total return, I mean, money produced by that investment arms, and bring it to his foundation, Open Society, etc., and be a philanthropist with that. But I mean, that's a bit schizophrenia, right? I mean, you eventually do a lot of harm with your left hand and correct it with your right hand. And so he's kind of the first to have moved to decide that all his investments now should be thought in terms of their more holistic impacts. I don't know if that answers the question, which is more like a joke, but... Yeah,
the question, I'm just saying the way the person phrased it, it would be a huge. 0.1%.
Yeah, it's yeah. We don't know how many decimal we need to use to to describe it. Okay. 45 minutes left. Okay. All right. So a few examples of the confusion and how people are not really educated or helped to understand what's happening. This is just yesterday. I think it's constantly, you constantly have this kind of bizarre statements. So at the bottom here, you see that basically we face continuing political and economic uncertainty. Basically, it's not going to be great. A price of falling, etc. And then what is the reaction? Market is buoyant. It's fantastic. Markets go up. Markets go up because things are going bad, essentially. So the narrative is kind of bizarre. And I think the reality behind is that whatever happens, stocks will go higher. Whether, economy does well, that benefits stocks. But if it doesn't, those who own stocks know that the central banks are there to help them. So they will do whatever it takes to keep propping, securities prices higher. So essentially, central banks' governance work for the top. But that's what it says. If you really read those two statements together, that's what it says. Another thing which is quite often misunderstood when looking at finance and investments, at the top here you have performance chart. So, what happens with your money if you put £100 in this fund across time. So year 7, you hire, that's the highest you get. And you had a little bit of a bumpy road, but not that much, Actually, if you see performance here, I imagine 20% performance in the first year, 10, 6, minus 2, disaster. 7%, minus 5, not a disaster. Then 12%, great, right? That's a fantastic fund. I want to be in this fund. Okay, now look at what is the actual value, money created by this manager. This is the green bars here. It's massively negative. Yes, it can absolutely be the case. And actually, I have many examples, especially in the hedge fund world, where you see those, hedge fund managers who boast themselves, having been so impressive in performance. But the reality is that because of the herd behavior, because of, you love to buy what's worked in the past, people typically pile in investing in things that have already run their course. And so I take a little bit of an extreme example, but if you imagine how much money was managed by this guy, following this sort of pattern, let's say 5 million, 10 million, 100 million, a billion, 3 billion, 20 billion, because it was been so successful those previous years. And you take, for instance, Paulson funds, that's kind of the story. You will see that those are really the numbers, there's no contradiction. And that's why, you go to any asset management company, they will show you nice performance charts. It doesn't mean that they actually create wealth.
How are you measuring the creation of wealth?
I'm just looking at how much is, 20% on 5 million. Well, that's 1 million. Then, if I go to that year here, you lose 5% only. That's not a lot. But you lose 5% on 20 billion. So you actually lose $1 billion. I mean, for the asset manager, it's okay because, again, remember, he's getting a percentage of the AUM. So his own wealth has definitely increased a lot.
And does he share in the losses as well?
And I'm sorry?
Does he share in the losses? Does he have to pay?
No. I mean, no. He has.
Don't be silly.
Come on. No, he shares the loss in that his AUM will go down. If he loses money, obviously people will not be very happy and they will leave.
But even be punished by market forces. He's not punished by.
No, it's not.
Because they cover themselves with the fees. So, like, if we win, I'll take half of it, but then cap the losses.
Had I win, tails you lose. Now I'm introducing some of the oddities that I find in some of the ESG conferences, or what people discuss when they present themselves as being actively promoting the idea that we need to invest in a more sustainable fashion. This is out of the Bloomberg conference I was attending just 2 days ago, where it was presented the various strategies to tackle global change, and through investments were presented, and I thought it fascinating that this is therefore assuming that we still live in a normal functioning world, but it is also assuming that we still have quite a significant portion of energy produced by coal by 2050. So we're absolutely not in line with the IPCC recommendation. So we know we'll be well above the 2 degrees. So we know it's not going to be a well-functioning world. But anyway, that's an inconsistency that people don't really think too hard about. Another one, if you look at, this is a very famous 17 Sustainable Development Goals. There is still this economic growth being mentioned as participating to being sustainable. I mean, isn't that inconsistent? I mean, that might explain why we will still continue to burn coal in 20 years. But. Sorry?
Why is that inconsistent?
Well, I think it's difficult to envisage that we can continue to grow and to reduce the footprint. I mean, again, it's a debate. People will tell you that technology will be coming soon enough and smart enough to reconcile the absolute necessity to diminish the footprint very, very radically with the fact that we might all continue to get, all, again, in a very unequal way, but to get richer and produce and consume more.
What is, cumulative GL?
Cumulative gain losses. Gains and losses. Another thing that strikes me when I go to those conferences is that we talk a lot about electric cars and mobility, but there's one thing that is almost never talked about. Well, you probably, I'm sorry, this chart is not clear enough, but it's just 40 different issues that have been investigated by the Bloomberg team in terms of all the dynamics and interconnections, mobility, heating, energy production, plastics, textile, etc. But there's one thing that's missing. This elephant is missing. Actually, it's not an elephant, it's a cow. We don't talk about food. Very little.
The footprint.
The footprint of food. The food system is completely on its head. I must say that conference was sponsored by Syngenta, so maybe it's an information. Well, they are one of the top 4 seed and biotech company. They are not as bad, I would say, probably as Dow or Monsanto, but they're definitely in the camp of pesticides and fertilizers, etc. So for them, it's very important to keep the current system running. Bolsonaro in Brazil, deforesting, that's great. I mean, more crops to feed more cows, to feed more Chinese, fantastic. And this is what's destroying us. Actually, more and more people, when they investigate the topic, they realize we'll starve to death before we heat up. That was out of an article, I think, Monbiot article in The Guardian. What?
Sorry, it was funny comment, as true as it is.
How much land you require per gram of protein if you use beef as a condom to get protein in your body? And you compare that to, just getting it from cereals. I mean, obviously, we should be just eating cereals, locally produced, and that would be a much, by the way, also a healthier way of getting amino acids in our body. But no, the current system is pushing us to use more and more this absolutely ridiculously stupid and effective way of getting nutrients in our body, which is to use cows. I mean, the number of also water that you need is, I think, around 120,000 liters of water per kilo. Yeah. But it's not just water, it's also destruction of topsoil. I was having a discussion in the previous Bloomberg Sustainability Conference with Emma Howard-Boyd, who's chair of the Environmental Agency, who was telling me we are down to 36 harvests where we used intensive agriculture. That's in the UK. And you need, in most places, you will need more than 20, 30 years to regenerate the soils. Organic matter in topsoils is what you need, and it takes a lot of time when you've completely destroyed the bacterial life and microbial life in the soils.
It's not just the fertilizer, also the heavy machinery still studies.
Absolutely.
Compression and
Absolutely. Yeah, absolutely. And this idea of GMOs and crops, all this comes from the idea that you want your crop to be easy to harvest by the big, 20th century machinery, which need the plants to have reached the exact same size at the same time. Another number that maybe I could mention here, I'll ask the question, do you know what was the average revenue, yearly revenue of the French farmer in 2016 or 2017? Must have been quite similar. 18,000 euros, right? But that's after subsidies. What was the number? Yeah, what was the number before subsidies? So if they didn't get any help from Europe or from various programs so that they can buy their fertilizers, their fuel for the tractors, for the machinery, etc., the pesticides.
Probably the same as it is in Senegal or something that's equivalent to a global price.
Minus 22,000 euros. Minus 22,000 euros. Which basically tells you that our food system is in the hands of the petrochemical agro industry, which has found a way to ensure that the governments would channel that money, so 40,000 per farmer, into their pockets. And you end up with what you get in your plate, which is food without any nutrients and full of pesticides. That's our food system. So there's a lot that to change there, but it's not really being talked about in the ESG conferences, and that's what makes me a little bit nervous about the ability of the current.
I think in India there's been a massive shift in the last few years. People going because of the soil depletion, erosion, acidification, and the possibility of farming to keep up.
Well, you had more than 100,000 farmers committing suicide because of the sea, cotton, Monsanto brand, etc.
There's a movement quite successful now that they're bringing farm together to scale back. But, on the old-fashioned, at least they did.
And you're absolutely right, and this is a key point, is that the proper way of producing food is small units.
Small units.
Absolutely. But this is why it's so difficult for the existing setup to embrace it. Yeah. So that was, what we're talking about as being another of those 17 goals, which is a bit bizarre. The one about land, it's called life on land. not life in land. What I mean by that is, if you think in terms of what your body needs when you eat, it doesn't need, kilos of potatoes or kilo of whatever. It needs nutrients. And I'm sure you've tasted the tomato produced in Holland, or elsewhere, that absolutely tasteless. So you can eat kilos of them, and they cost a bit more than the rest. But you think at least I won't get bad molecules in my body without. And yeah, you will get much less bad molecules than if you take non-organic, tomato. But what you really need is much more than just some sugar or some of those lipids, proteins. You also need. You have up to 80 nutrients that your body needs, oligoelements, vitamins, etc. If you go to the Canadian website, I can't remember the name, but that gives you for I think 80,000 different items you can buy from supermarket or grocery stores. It gives you 80 columns of nutrients, so you know what you will get. You don't know though when you go to this database the difference between organically produced or non-organically produced. They won't tell you that difference. Yeah. But you should know, for instance, that apples 50 years ago contained 8 times more nutrients than today. So the collapse in nutrients contained in food is absolutely gigantic, and is directly linked to what we do to our topsoils, because it's all this ecosystem of it's dying. It's completely dying. Worms, have collapsed by 90%. The entire ecosystem is being totally destroyed, and it's the ecosystem that manufactures the complex molecules that you need. You can't live just off, sugar and lipids, and that's not enough. This is an example, by the way. Is it potentially viable economically to think of food in terms of nutrients and nutrient-rich food produced in local units? And it absolutely is. I don't know if any of you have seen the movie Tomorrow or After Tomorrow, but they mention La Ferme du Bec et Loin in France, where it's been, actually this year is a result of a study done by INRA, which is a French agronomy institute, and they have actually verified that it absolutely is economically viable. On only 1,000 square meters using permaculture technique, they are collecting north of 50,000 euros of revenues. With of course some more, it's some more labor intensive than the very intensive agriculture, but still, it's much more viable. Profits per square meter is just about 10 times bigger than intensive agriculture. So it's quite impressive that despite you see this, again, you have such a little impetus coming from the big world of big institutions towards, yes, I need to accelerate. So now you have a few bright spots. I'm showing here Beyond Meat. They went public just a few weeks ago, and it's quite interesting to compare Beyond Meat to Uber. Uber also went public recently. Their stock price is still about the same level. Beyond Meat is like 3 times above already. Okay, so I'm going to accelerate a bit. Can the investment world help? So with what has been said so far, we're kind of cautious on that. We already talked about the first element, which is risk aversion. And risk aversion very much as a result of zero rates. Zero rates, why? Because think of it, if you go to someone to manage your money and hope that he will deliver, say, 7%, but he only delivers 5%, You will not be extremely happy, but it's fine. But going negative, there's a psychological barrier. The problem if rates are at zero is that it's kind of the benchmark for yields in general. You know, in a 10% rate, when rates are, central bank rates, overnight rates are 10%, probably it's because there's some inflation or some reason why, you know, everything grows relatively quickly. So it's much easier for asset managers, for investors, to take risk, because if they make mistakes, they will still end up the year in positive territory, unless they really go crazy. But when you start from zero, being your benchmark, the smallest mistake, you're in negative territory, and that's a game over. Also, the behavior of central banks has been one that has not been very conducive of discipline or trying to do the right things, because ultimately, you know, if you do stupid things as an institution that is systemic enough, well, the system will respond by making your life, you know, easier. As a person, you lose your career, but as an institution, you don't. You will be maintained even as a zombie institution. I guess what has happened also is that you more and more have people who will look over your shoulder, and you will prefer to outsource to experts. You will prefer to get someone else to get on the line than doing it yourself. And and that's what we had just discussed before, you would previously try to build your career in investment as being good at spotting what will change in the world and how to adapt to it. Now you are much more incentivized to just demonstrate that you're good at pushing costs down. So you're becoming very much like, you know, in most industries, someone who's able to fire people to get costs down, or to bring in technology, such as, you know, algorithmic investing, where you use computers rather than people to make investment decisions. And in the last 10 years, it's been an incredible success for all those that have brought ETFs, for instance, or any products that, you know, can demonstrate that, okay, they may be not beating the market in a very impressive way, but at least they're not wasting your money by paying people who actually don't have any talent. Because talent, you know, investing talent is a fallacy that people no longer believe in as much. 2008 has come also as kind of a awakening call that even those who have been very successful typically were the one that had the biggest, you know, downfall in 2008. So. And what makes life for investors even more complicated now is this intrusion of this ESG thematic. So certainly you do have a minority of ESG minded shops, small shops that have been vindicated by the wave of, you know, interest for ESG, sustainable investing, or greenwashing in that field. But that's a very small fraction. The vast majority of investors are rather puzzled, and, you know, it's extra cost, basically, extra like compliance layer that they need to invest in, so that from a marketing standpoint, they will still be okay for the investors. But they haven't really understood how they can make that a contributing factor to their investment success. It's more something, an extra cost they have to take in. That's another, you know, interesting take from it's a friend of mine, Neri Abele, who runs Oriel Equity for a number of years and has now developed technology to make assessment as to how much funds that present themselves as being, you know, SRI or ESG funds really help the sustainability agenda. And according to his metrics, at least, it's not so clearly the case. A lot of that comes from the fact that most people, when they say, I'm a good investor, I'm a good ESG investor, it means I will only buying the good companies. You know, I'm not touching the sin stock, I'm not touching the bad companies. But when you really think of it, it's not so clear that when you are well-intended, not touching these companies is the best way, because what happens when you sell them? Well, you sell them to someone who cares less about it, and who will be less incentivized to try to do to apply some pressure on the management so that they adapt, they change, they make things better. So somehow you could almost say that not owning the bad company or getting rid of them is the best way to ensure that they will continue to behave badly. All right, so I think we've already mentioned some of that, but the first point, there is more and more skepticism about ESG data as well. I mean, you take the example of CO2 emissions. It's getting better disclosed and reported, at least in scope 1 and 2. When you get to scope 3, this is where a lot of the confusion happens. Scope 3, I don't know if I should explain or... So scope 1 is just how much emissions are produced by a given plant manufacturing. For instance, take the car industries. Well, to produce a car, you emit carbon. Scope 2 is when you take into account that you need heating for the workers, or workers need to come to your plant every morning. So that also means some emission. But obviously, and car is a good example, the combination of scope 1 and 2 is small compared to what scope 3 is, which is when the product is actually being used. How much emission would that mean? And scope 3 is a much harder one to guess. So even in the area where you would think there's been quite progress in making sure that you quantify things, it's not so clear. Yes, it's upstream and downstream. Should be absolutely, yeah, the entire cycle. Yeah. Another thing is that when you imagine you are running an ESG agency, an ESG rating agency, so you're supposed to look at a universe of 8,000 companies because you need to satisfy your clients who are typically global investors who look across the planet, all sectors. That's a lot of companies, so you need a lot of people. Even more so because you are going to have to investigate maybe up to 300 different key performance indicators, criteria. You want to be sure you get a good hand over all the environmental issues that this company might be involved in, or social issues, etc. So you have now 8,000 times 300 data set to be constantly updated. So this takes a lot of people, a lot of manwork. And how much money do you get for that? Well, the problem is that mostly today ESG data is being used essentially for reporting, marketing purposes. It's not really being used by the investment teams. When you look at how an asset manager allocates its revenues, it allocates far more to resources that help him get better investments in his portfolio or her portfolio than investing in marketing. The marketing budget is small. And the ESG data is produced out of marketing budgets. So that is one problem. Okay, all right. Okay, so I'll just, drop this. Talked about governments, which are still very much addicted to serving the interest of those who have the biggest leverage on them through jobs. That's why also basic income is so much required, because that would finally allow governments getting out of the grips of lobbies, basically. I will not mention all of that, but maybe just the last one. There is a lot of fuzzy feelings that investors have about their fiduciary responsibility. Because up until recently, it was still, you could still hear a concern that if they were starting to pay too much attention to so-called non-financial factor, which is in itself a completely stupid way of talking about environmental issues, then they would probably destroy their reputation with people who consider that the first objective of an asset manager is to grow wealth. Now it's shifting, but it's not yet at the stage where the most advanced advocates of the sustainability cause would like to see things, which is that an asset manager should think that maybe in the future he might be held responsible for not having incorporated those long-term concerns in the investment process. It's still quite unclear whether that will happen, how it will happen. It's when also you take the way, for instance, government schemes have been put in place and then revoked to help certain sectors grow, it makes life of investors very difficult. You know, should I invest in solar manufacturer if it's based on subsidies, but the subsidies might be taken away? So getting more clarity from governments on their policies or regulators would obviously go a very long way. I think Bank of England is a bit ahead of the curve in terms of being good at framing the discussion on that. But in many places you have still quite an incredible disconnect between the stated intention of government and the actual decisions being made. And France is unfortunately is a very good example of that absolutely incredible disconnect. Impact, this is just an example of how some investors go about trying to highlight their performance beyond just the NAV equation mechanism. So in terms of the impact they have in reducing footprint. I will not go through that because we don't have time. Maybe just the last comment on the 10 minutes? On the way essentially we should think about addressing, I think, connecting with this world in terms of interdependence is to think about going to the more agile investors because that's really where agility, intuition, and a holistic view is what is required for you to really appreciate how to build your portfolio away from what's coming from career management or just sticking to the herd behavior. Because as we've seen or strongly believe, the herd is not going in the right direction or certainly not fast enough because the incentives are not there. What you see a lot of time in the carbon world, it's quite often the case, people are starting to show, you see it's working. If I decarbonize my portfolio, my returns are better. And I think it's good, although, I mean, it's only in the long term that you should be able to appreciate the value of incorporating long-term objectives. The fact it's starting to work right away doesn't really prove that in itself you attaining the goal. It rather proves that you got there sooner than others. So it's just the fact that other people are joining that creates this early stage performance that you see in most articles that talk about decarbonized index, etc. But it's not bad. I mean, that you get more people on board, even if it's for the bad reasons, because they might get addicted to finding ways of getting better performance out of becoming more sustainable. So, okay, so this just summarizes how and why we should go about using the existing investment world for a purpose. And I think the one thing I mentioned here is really asset managers, in particular infrastructure funds, because we'll mention them when we talk about the interdependence bond. I think it would be totally illusory to think that we might get them interested to join forces with us away from their standard way of trying to generate commission out of delivering yield. So we'll have to keep in mind that yes, we need scale, so we will need to join forces with people who are able to bring money from the mainstream world, but we'll have to accept that the generosity will have to come from us to jumpstart the process. So yeah, I'm probably going to skip that because if you want to talk about the interdependence bond, this was just again a reminder that what we are here for, which is the locally produced food and electricity to start with, and there might be other elements, mobility, etc., that housing also to come at some point. All this locally, low scale, etc., goes completely against what's behind the universe of investment as it exists today, and that's really where the difficulty lies, because we'll have to make sure we bring in projects in the form of pools of assets that are standardized enough so that they look like another large ticket opportunity. Different ways to solve the issue, and the last one is what we should talk about now: interdependence bonds. So, Sam, you had a workshop on why we need them, so I'll skip that and go directly to the formula, to the example. So first, a numerical example. So just to explain how these things is going to work. So I'm going to just look at one stage and then the next stage, and then it's incremental along the way, with exactly the same principle. So I imagine we've already gotten into a situation where there are 11.5 million of assets in the interdependence treasury. How did they get there? Well, there were donations, probably around, I don't know, 25 million donations up until that moment. And those, I don't know exactly what the number could be. I mean, there are plenty of scenarios that might have landed us in getting 11.5 million. Well, actually, no, I probably know the number because I got 20 million of ID bonds there. So there must have been around, let's say 35 million maybe of donation. Doesn't matter. That's not the point. So consider there is 11.5 million of assets in the interdependence treasury, because previously donated money, some of that was kept to help fund all sorts of not necessarily economically viable projects. 20% of the money is going away from the infrastructure per se, but 80% of the money donated goes to co-fund assets that locally produce energy, clean food, etc. When you have money, let's say £100 donation goes into infrastructure, so the £100 become 80 going to an infrastructure fund, and out of the 80, some of that will be given away. Will be given away so that we go and pay the lawyers to sort out the contracts, that we educate whoever needs to be educated to operate the facilities, etc. Essentially, the infrastructure fund that we will co-fund with, they will want to continue to make as much money right away, not having to pay the upfront cost, as they do on large-scale solar plants. So they will say, I'm not interested in putting panels on the rooftops unless you take those upfront costs. So we'll do that. So the £100 that goes to 80 will get back from being a co-investor in the fund, let's say only 60 or whatever is negotiated, having given away what's needed to jumpstart things. And this ratio between the 60 and the 80 is what we call the participation rate. So how much does interdependence gets back from the money that's being invested in the infrastructure, in the assets? And so in this case, the accumulation of those 60, if you want, 60 that goes back, is 11.5 million. So we have 11.5 million.
When you say 11.5 million, you mean of shares?
Yeah, that's the value of the shares in the various infrastructure funds that we have become, or interdependence treasury has become a co-investor.
Maybe just to clarify as well what you were just saying there, so that money
Yes.
I think that's probably how most people understand.
It's a subsidy, yeah, to jumpstart an investment, to incentivize the infrastructure fund and get them interested in bringing, for instance, having 4,000 different places where or rooftops where you'll have a solar panel on will require relatively large size ticket of 20 million pounds or something, and they will bring most of it. So that's the beauty of this model, is that we don't need to raise 20 million. We can raise just 2 or 3 million for this project, and that will be enough. If our participation rate on 3 million is 50, then that means 1.5 million can be spent. And obviously, everything suggests that the first deals that we'll make will be deals where we'll have to give away quite a lot in percentage, because they will be small, so the absolute number will only be big enough if the percentage if the participation rate is low enough. But also because as we grow and get bigger, a lot of those costs won't have to be paid twice. I mean, everything that has to do with legal and education, that's you pay only once, or most of it once. And also because the scale is bigger, the item is bigger, then as a percentage, you can raise the participation rate and still leave a lot of money in absolute terms on the table. So participation rate is a key factor here. It will start low, but it will increase. And this is an important element to keep in mind. The 11.5 million do not include any bond. The interdependence bond are certificates that are issued.
Money comes from the
yes.
It's not mixed at that point.
Okay.
So that 11.5 million represents money raised from the sale of the bond, and that's used as co-investment with other institutional money, asset management money, family office money, as seed funding. So the 11.5 million becomes seed for a lot more money to come in.
Yeah, exactly. Yeah. I mean, eventually we'll have some institution that will take the donor's route and will accept also that some of their money is immediately 20% is spent in other venues, and the 80% that goes into the infrastructure fund go under concessional terms, where some of it will be spent right away to jumpstart processes. And then there will be also holder of certificates of the interdependence bonds. Okay, so just because you have 20 million of bonds already issued and that they are backed by 11.5 million pounds worth of assets, that immediately means that the value of one bond is 0.575 pounds. Right? That's very simple math. Now suppose the next round of donation happens, let's say a year later, and the 11.5 millions worth of shares that you had at time one now have become 12 million. Just because, normal life of real assets that produce a good yield. I mean, there's a total return accretion mechanism that is natural to the positive yield of those assets. Obviously, the rule is we only invest in economically viable projects. So once we've paid the upfront cost, then it's supposed to be the case that you will see accretion, natural accretion of the assets. But there's something else that happens. If you have another round of donation where now I'm considering here 8 million are going to be donated at time 2, and there will be a higher participation rate than what has been achieved so far. It's going to be 85% participation rate. This means that as you get 80% of the 8 million going into those assets and 85% of that value coming back in the form of shares, that will be added to the 12 million that are already there. It means you will add 5.44 million to the 12 million. So now you have 17.44 million in the interdependence coffer, if you want. just as a result of this extra donation. The 8 million donation round has resulted in 5.44 million more in the assets, which will back the bonds. Now, how many bonds should be given to those later stage donors? That's really where it's the peculiarity of this construct. Well, the idea is that we will want the ratio of how much those new donors will get of their donation money to the value of the bonds that they will get from donating the money to continue to be in line, to continue to be the same as for the early donors. So that's what's written here. We want the number of bonds attributed to the new donors multiplied by the price of the bonds to be worth half what they donated. Right? So you have two numbers we need to put a value on. How many bonds will be issued? And what is the new price of the bond? And we only have one equation. No, we have another equation, which is we want always the bonds to be backed by the assets. So how much assets we have? We have 17.44 million. How many bonds? Well, those we already had. We had 20 million bonds so far. Yes. And now we have this unknown additional bonds being issued. And we know that multiplied by the price of those bonds, it should be back, so it should be 17.44. So it's just two equations, two unknown, you solve it, and you get the result. And what you get is, before the new round, you were at 0.575. And now that you had the extra donation round, the price of the bond jumps up to 0.672. And essentially, that's much more than just the fact that the assets have yielded positively, because that has brought only from 0.575 to 0.6. The 0.6 to 0.672 is coming from an accretion mechanism whereby essentially later donors accept that because they came later and it's already safer and a lot of the work has been done, they accept essentially some of their effort to help and reward the earlier donors. Right? And all this can, of course, be put in.
Does everybody understand that? Yeah. Or any questions?
Yeah, so this later donor gets in and he's, if you want, buying the bonds at a higher price, and he knows that some of the money that is being given helps previous donors, but there will be more donors. I mean, remember, 300 or whatever trillion worth of wealth, so sky is the limit. So, I mean, if we're successful in demonstrating that there is ever higher participation rate, even you can imagine at some point, this thing gets successful enough so that when we go to infrastructure fund, we're not begging for their attention, we're actually getting them to queue out of the door, and we auction the right to be participating in something where they will be able to shine with their own investors saying we're participating to some very interesting project here. So even this donor who comes in at, you could say at a later stage when there's already 12 million in interdependence, is still actually a very early donor compared to what's coming later. And we run some modeling of what the price of the bond could be in base case scenario where we have a natural way of thinking about the yield of those assets and the equation, and the size, etc. And you typically would hope that most people could anticipate to be donating 100 and getting the bonds that they got against this donation to be worth 100 again, probably between 5 to 10 years later. So it is very much in line with what of course you donate, you take a risk. If you really want to be sure that you will not lose any money, you should never buy these things, right? But that's not the purpose. The purpose is to address a solution to people who understand that the current world of finance will not produce by itself because of all those mechanisms we described the solution, and you need to bet that another form of investing has to emerge, another form of building assets has to emerge, and if and when that happens, indeed, you will not have made a bad investment decision. Yeah.
Yeah, so the idea being that when somebody makes a donation, 20% is going into things like climate solutions, programs like this, training the generation of entrepreneurs, building a digital platform to connect people, which does have value, but it's not likely to necessarily generate a return. Whereas physical assets that are particularly producing energy or food should generate a return. So although you're sort of losing, in inverted commas, 20%, actually it's going towards building infrastructure that hopefully builds a better world. Yeah, that's the thinking. And it's functional.
And if you look at how that compares to other backed assets, for instance, you might have heard of the new Facebook currency that's come out, and they are trumping the fact that it's backed by securities, government securities, bank deposits around the world. But actually, that's only up to 20%, and they're saying that's 4 times more than banks are mandated because.
No, 20%. No, here it's backed 100%. In the case of Facebook, I think they say it's backed only 20%. So it's a fraction reserve already system.
Exactly.
But they say it's more conservative than the typical banking,
which is 5%
fraction system.
Right. So the maximum in this current model, the maximum that can be backed by is 80%. Well, it depends how you think about it. You're making a donation of 100, and you're getting 80 bonds, and all of those 80 bonds are backed by £80 worth of assets. But you've also got 20 that are going into other good things. And we have been briefly discussing whether or not we might want to create a token for those the impact side, rather than the infrastructure side. Maybe psychologically, if you're putting in 100 and you're getting 80, that feels like you've lost something.
Well, you're not actually getting 80, you're getting less than that, right? I mean, the actual value recognized by the system at the moment of donation of those bonds, I mean, in this example, it's more like 50, right? So you put 8 million, you get a number of bonds at a certain price whose aggregated value is 50% of what you donated. Over time, though, we will introduce we have a mechanism also, and so it's getting into a lot of details, but whereby, obviously, imagine we are 7 years later, participation rates have been, already in the 19% plus or 95% range for quite some time. And it would be unfair to keep asking donors at that moment, and would maybe disincentivize them, that they would only get 50% of the money they donated back in the form of bonds. So we will actually raise this 50% ratio, which will be kept 50 for the first 3 years, to gradually shift higher as well, by saying that it should be based on the weighted average participation rate observed on all the transactions that have happened in the previous 3 years. So there's a kind of natural mechanism by which there will always be a lag, which will allow earlier donor to benefit from later donors. So this accretion mechanism will continue to always be there. But many years down the road, when we will have plateaued, say, to become almost like asymptotically like a mainstream firm of today, like everything we do is right away, profitable, etc., then this will have also collapsed to basically you get as much as you've put in. Except from the 20% that always will have to be spent on not purely economically viable projects. All right, thank you very much.